Welcome to the Trading Zone. I am Joe Teague, portfolio manager at Equity Armor Investments. With me is Brian Stutland.
Yeah, how you doing? Also portfolio manager, Equity Armor Investments. Every week on Mondays, we give our insight and opinion about the markets personally, how both Joe and I are seeing it, along with at the end, stick and stay tuned in the whole show because we give a trade idea at the end, which, Joe, you've been kind of on fire with the last few weeks. So kind of an update to that trade coming. And, you guessed it, the stock NVDA that everybody wants to know about. That will be the trade. But we've got a very big story this week talking about interest rates, talking about volatility, and how that's affecting both the NASDAQ and the S&P 500, where those are willing to go, and maybe some option trading ideas around that to go with it.
Yeah, big week, of course, ahead as usual. But I think this inflation data is going to be really important, given what we're getting into next when we talk about the volatility. We got the CPI, PPI coming out this week, and that's going to move the market. Interest rates are very sensitive right now to what's going on out there with inflation, and it's going to be a crucial report for me. Also out there, we got extreme fear in the CNN Fear and Greed Index. The contrarian enemy is saying, hey, wait a minute. This is when you want to buy when everyone else is selling. Kind of want to do the opposite of people. That's always true. Not always true, but it's very often true when it comes to volatility. I've seen this a lot of times in the volatility world. Brian and I, former VIX options market makers. Brian was one of the very first VIX options market makers to be in the CBOE pit, trading that volatility right when it opened up.
But we hadn't brought that indicator up in quite some time, actually. So it's kind of interesting that that's gone to extreme fear. And I think, Joe, what you're going to hit on here next is what has not gone to extreme fear, and it maybe is one of those leading indicators in the volatility space. Joe, why don't you walk through people where the skew index, how put traders, institutional traders are treating this market, and what kind of fear do they have for the downside?
Yeah, so, last week we had talked about this level here, this 4 area in the skew index. This is an index which we like to look at as vol traders. This measures the difference in the 25 delta put versus the 25 delta call. When it's very high, people are paying a lot more for the put. That's kind of a sign of fear for us. We noticed, this may be a little bit of a floor here around 4. But that said, we're trading at a much lower level now with the S&P 500 lower than it was at the end of the year. So, when we saw the last time we saw the VIX spike. So, Brian, what does that mean to you when you're seeing, we're having a lower low in the market, but we're not really getting any movement in the VIX or volatility?
Right, we're really not. And to me, when I see that happen, what happens is this skew indicates the demand for the put, right? And if the demand for the put is not as high as it was, let's call it a few weeks ago in December, when we saw the markets drop, the stock market is now actually lower than that low in December right now. And yet the put demand is not as high. So to me, it shows that put traders are actually selling a put, trying to find a level here in the market where they're going to be like, okay, look, I'm willing to get long the market down at these lower levels here if we go any further down. And historically, when we've seen that, obviously the VIX is calculated off this whole entire skew of the S&P 500, meaning the premiums of both the put and the call. And if people are selling that put, it makes it more difficult for the VIX to go higher, for fear to really rise in the stock market fear, not that indicator that we showed you before. And so to me, this is kind of interesting because when we've seen this sort of dictation, it's been sort of a leading indicator that the market is trying to find a low, that the market is getting ready to bounce. It doesn't mean we're at the low. We've obviously, Joe, seen that. You're more worried that there could be a little bit more downside to go. But at least we're more than halfway, maybe more than 2/3 of the way down from the high than we need to go. And this is where the market starts to try and bottom.
Yeah, it certainly sets up a very crucial report this week with CPI and PPI. I think if it's a lot worse than expected, people selling these puts might be in trouble. They might be forced to buy them back. You'll see volatility race higher in a big way. Or on the flip side, people selling these puts have a very strong hunch, and they often are right, more right than they're wrong, that it's going to be a good CPI number, and we're going to see volatility trade lower after it. And it also goes along with the major thesis that we've had, Brian, on this market, is that we've got these rates going higher because of the strong economy. You also have very high PE ratios. if these PE ratios come lower with a strong economy, people are going to want to buy these stocks. So people are just picking a level where they want to buy these stocks, selling the put there, and just waiting for them to come in line. I think that makes a lot of sense, given what a lot of people have said about this year, high PE ratios. It's hard to get more returns, more squeeze more juice out of that lemon. But when the PE comes down again, it becomes attractive again. So I think that's exactly what we're seeing here with this skew. It's actually backed up here with the futures curve here, Brian. We have the front month lower than where the spot is. So people are expecting after this event the spot to come lower.
Yeah, I would expect this curve get back into the mean reversion, kind of like you said, the spot price to drop below the front month to drop significantly below the second month, and for the VIX to head maybe back into that 15, 16 range and sort of mean revert back to where it was from previous times. And so look, I mean, you look at that setup, volatility traders are really, I think, have a bullish sentiment right now for the stock market. Joe, really our big story that we're going to talk about, though, is the bond market, not so much bullish for everybody. And we're going to have to try and figure this out and who's going to win, or maybe volatility traders are sort of the leading indicator.
Yeah, well, we'll see. So let's real quick just look into the charts here. This was a very crucial week last week. The S&P 500 breaking down below this trend line. This, is something everybody is aware of, this head and shoulders formation here, this top. This is very dangerous. We don't want to sugarcoat this. This is bad news for stocks that we broke down here. And it's because the yield's going higher. There's no question about it. Yields are breaking higher. We're getting the 10-year at 477 this morning, and stocks are breaking down. And, that's understandable. Not surprisingly, you got the same formation happening here in the NASDAQ. Even worse, of course, a little more growth heavy. This, kind of is that head and shoulders right there, but it's like a triple top, Brian, which is just breaking down.
Yeah, and look, I mean, the charts, the technicals don't look good, but sometimes these sort of formations need some sort of confirmation that they're that they are actually breaking down, that they are becoming bearish. And sometimes when you don't get that confirmation, the rip back to the upside is extreme. It catches people off sides. So we have some interesting trades, I think, around that when we start talking about our trade on NVDA. Probably could be applicable to other parts of the market as well. Here, the semiconductors, again, we've normally seen them be a leading indicator. They just can't get out of their way. They're
kind of stuck there. Yeah, this is the case of the stocks, or the PE ratios just trading sideways, catching up to themselves. But this doesn't look as bad as some of the others. We're not making these lower lows here. So maybe that's a green shoot. But yeah, it does come down to these yields, and just look at where we are. We're at 450 is where the Fed currently is. We're up to 30%. People think the Fed will not cut this year. That was only 9% a month ago. So there's been a big move towards zero cuts this year. But the flip side is that's because the economy is stronger. So you kind of get a push and pull. You got a strong economy, higher interest rates hurts the economy. You kind of take 2 steps forward, 1 step back, but in the end, you're a step ahead. I think that is hopefully what's going on with the economy. That's really the best case scenario. But this is the chart, Brian. This is the 10-year yield, absolutely crushing it. Breaking out, in most of the time here, the market has gone higher since September, while this yield has been going higher. And we can actually see that. I put the NASDAQ in here. This is us in September. Get the NASDAQ racing higher. We got 10-year yields going higher.
Yeah, I think it's interesting that the NASDAQ, it kind of has a bond trade to it, really. Like the NASDAQ does like for rates to stop rising, for them to fall. So essentially you're long, like a long-term treasury yield inside of owning NASDAQ-y kind of names. It's kind of interesting. So it seems like, you could own one, not both. And that's why, like in one of our funds, we own NASDAQ, but we own volatility with that, because we don't find the need, if you want to create a balanced situation, find a need to own treasuries in that scenario when you're owning the NASDAQ. And you look in here, what's really interesting is the NASDAQ really struggles as rates start to extend and shoot higher. And it's not until they stop moving higher that then triggers a rally in the NASDAQ. So the question is volatility traders saying that the 10-year is going to stop moving higher, Joe? Or do we need a double confirmation? Do we need volatility traders to give us a signal and for the 10-year to also give us a signal before you'd be a buyer of the NASDAQ?
Well, yeah, one thing we can say for sure, though, is that the 10-year going higher is a major headwind to the growth stocks, especially the NASDAQ. And when that peaks, when the 10-year stops going higher, boy, does the growth stocks like that. So, I mean, it's especially true here in September. You know, it's especially true here in March of 23, you know, after like the regional banking crisis. So I think there's every reason to think, you know, when these rates stop going higher, we're going to see these tech stocks take off. The only question is, are we going to stop here in the 10-year, or are we going to stop above 5?
Right. So it sounds like for you're more leaning towards you need a double confirmation. You want to see interest rates stop. You want to see volatility traders and the VIX making lower highs before you're ready to jump in. I myself, I'm maybe a little bit, trigger happy when I see volatility traders start to sell those puts when the skew stops going up as high. I sometimes like to jump in, but I think the initial jump in trade is not an all-in trade right now, because I think, Joe, to what you're probably leaning towards is double confirmation. That's where I'd really want to get long equities. Here is where I probably use some options, some call options to express a long trade and get in that way and sort of dip my toes in there, because, you know, Joe, we've seen over the last 5 years, the volatility rips to the upside are just as big to the downside. And a lot of times that call pays off when I start to dip my toes in there and do it that way.
Yeah, and if I'm hearing you correctly, it's like you got some spidey sense. You're kind of reading the tea leaves in the market. You're feeling that the volatility traders are saying this is going to be a good inflation report this week. We don't need to worry about the downside risk. It's going to rip to the upside, and you know, stocks are going to follow. So that's certainly possible. I think that leads us to a little bit of concern, though. If it is a bad number, it does lead us open to the downside. So I'm thinking that volatility is going to happen this week, one way or the other. I'm hopeful that it goes to the upside.
Yeah, if I was going to express any interest in like selling a put, I would probably, you know, there is some risk to the downside. I would probably go, you know, a little bit further out, 5,400 strike, maybe even lower is where I'd be a seller of a put down there. That's why I'd probably want to use more of just a call, defined premium risk, buy slightly out of the money call, as we did literally right before the show came on, sort of kind of hit our signal to roll a little bit. So I did buy a call spread for clients in the S&P as full disclosure. So that's kind of how I like expressing myself right now. But Joe, I think when we get into really the big story, the big trade, I guess, so to speak, NVDA, you've got something on that, right?
Yeah, let me break down some of the recent trades, and then we'll get into NVIDIA after that. You know, we had a couple of trades recently. This is one that we put on, I think it was 3 weeks ago now. At the end of the year, we were going to buy the week 1 SMH. This is me having some ideas while you were in Florida living it up. That wasn't good enough. It wasn't going to finish in the money. I could tell that before week 1. So we rolled that. I rolled that to week 2. That was the right move. Took it off on Monday and had a nice winner there. Don't look a gift horse in the mouth is what you like to say. This is a trade I put on much earlier before Broadcom earnings, and I've just been hanging on to it. Just as kind of goes to show, being short a put has been paying off as opposed to being long stock here. So this is a trade. It looked like, oh man, I missed out on a ton of upside with it. Broadcom trading 258 just a week ago. Sorry, that'd be last week here. This is a 1 week back. So last week it was 258 and all the way back down to 225. So we're down $33 here in the name, but the trade is only down about $5.50. So that's where I'm at. So I had basically had a long call spread. Essentially, it's a short put spread now. which is what I'm comfortable doing. I'm comfortable holding that short split spread. And I think that my NVIDIA trade is something very similar. If you're looking at NVIDIA, Brian, we got a stock with, a mid-30s PE ratio. So that's not crazy high. It's a stock that's had like 3,000% return over the past 7 years or whatever. So 30 PE ratio is high. Don't get me wrong, but it's not astronomical. It's projected to have another fantastic year of earnings, but it's got a 200-day moving average racing higher. It's at 119. That seems to me like a level where a lot of people who are saying, hey, 140, 150, that's too high. Even where we are now, 130, it's too high to own NVIDIA. But if we got down to that 200-day moving average, I'd have to buy a little bit, right? I'd have to dip my toes in there. So I'm looking at that spot and saying, hey, sell a put there. If it goes down there, be long it, accept the consequences. But then I can also use those proceeds, finance it by buying an at the money call. And then I can also sell an outdated, way out of the money call all the way out in July. And I don't have to pay anything to get into NVIDIA here. So either I'm going to buy it at 119 or here if it goes higher. I think that is the way I want to own NVIDIA. Remember, they're going to have earnings after Feb expiration. So that's why I like owning the March risk reversal here on this trade.
Yeah, so I think this is like a time spread, but it's diagonal in the sense that if NVIDIA goes above 132 strike, Joe would be obligated, well, not obligated, but he would exercise his right to own NVIDIA 132 and higher. He's then sold a further out of the money call in a further back month, June option, where he would be called away at a much higher level. So from 132 to 175, he would make 1-to-1 with the stock as if he owned NVIDIA. The beauty of it, he didn't pay anything to get into the trade, right? So it's all profit from 175 to 132 area for him. And on the downside, of course, if the stock is below 120 level, Joe would be obligated to purchase the stock if exercised on the put, which would obviously happen if the stock were lower. And so he'd have to buy NVIDIA at 120 level. So if you look at this chart right here, yeah, I think the 120 levels probably a good level where people start to jump in. If we talked about the skew trade, the volatility trade earlier in the show. To me, those types of traders are setting up to want to own the market, something like a NVIDIA down near those levels. And then at the same time, you look at that sideways channel that NVIDIA is making right now. Now he's got the upside from the lower end of this channel here all the way to the top to new all-time highs. And that's a huge profit for him if it pays off.
Yep, absolutely huge profit for me. Remember last week we were looking at a call butterfly. It looked like people were thinking, oh, NVIDIA. Knee-jerk reaction was, hey, this is a head and shoulders top. We're going to race to a new all-time highs. Going to take this from this trend line here, going to go up to 175. I said, I'm not so sure about that. I'm thinking I want to own some volatility up at 150. Sold the fly. Turned out to be a very, very nice do. And now here I am, thinking of a different way to get long here. This is something where I don't want to own it below here, from here to here. This is like no loss here. I would want to own it here. Again, the 200-day moving average, that seems to be like a spot where people might want to jump in. I would love to own it at 120. And if it does go higher, this gives me upside exposure. So that is why I like this trade. It's a stock replacement trade. It's just a way to use options to have a little less risk on the table and get the same upside exposure. Obviously, I'm capped out at 175. I don't feel like this is another 300% year for NVIDIA. I don't see it having a huge surprise to the upside like it's been having again and again. I think those days are not necessarily gone for good, but it's just harder and harder the bigger you get as a company.
Yeah, for sure. I do love this trade, Joe. I mean, it's been a great show. I like this trade concept on not just NVIDIA, but maybe the whole market. By the way, Joe, the call I bought already is $1, up $1 since we bought to start the show here. This was a February S&P slightly out of the money call that I bought. So the market seems like it's trying to find its way. We'll see if it holds on for the rest of the day. But make sure you tune in every week because we update these trades. As you saw Joe talk about previous trades, we'll continue to do that. And be heads up, pay attention for our new time. I'm really excited about bumping up early. Joe, they love us so much that we got to just
they can't get enough of us.
Talk more, give people more time, right?
Yeah.
All right, this is Brian Stutland here, Equity Armor Investments, along with my colleague Joe Teague. Make sure you tune in every Monday at the Trader Hub, the show sponsored by the MIAX. Thank you very much for tuning in. We'll catch you guys next week.
Have a good one.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.